again from me, Kevin French at Core Wealth. Summer is here in South Africa, and we are going to have a look at what happened in markets locally and globally for the month of October 2025. So let's start with the biggest economy in the world, which is the United States of America. They had an interest rate cut during the month of October, taking it to the lowest level now in 3 years. This usually is a sign that we could see a little bit more impetus behind economic growth in the country. But the Federal Reserve Chairman at the announcement of the cut was quite hawkish in his comments. So it's not a foregone conclusion that they're going to continue to cut interest rates into the future. At the same time, we saw the gold price dropping below the $4,000 level, so still very high, but has come back quite a lot as investors and speculators into gold have perhaps felt that it's run a little bit too far already. The other big news in America is the government shutdown. It's now the second longest shutdown. It started on the 1st of October, and at the time of recording, which is now early November, it is still in place. There is some news at the moment that it could actually be halted in the next day or two. Basically, there's a disagreement around the federal budget and how it's going to be spent, and until the two main parties can agree, the president can't sign that into being. And some analysts are suggesting that for every week that the government is closed, it deducts between 0.1 and 0.2% of the US GDP. So if we have a look at the South African equity markets, the Johannesburg Stock Exchange, it's been on a really strong run this year, up almost 34% to the end of October. More than 2/3 of that has been driven by the mining companies on the Johannesburg Stock Exchange. Both if we look at platinum and gold miners, both of them up over 170% just year to date. However, the more locally focused companies have been quite pedestrian for this year, up sort of 4 or 5%. However, in the month of October, that all turned around. The gold and platinum miners were down between 5 and 10% just for the month. The local focused companies were up actually 8% just for the month of October. So quite a turnaround. The market was still positive for the month, but this is quite normal in stock markets. One of the most famous investors in the world that you may have heard of is a gentleman called Warren Buffett. He founded and owns a big chunk in a company called Berkshire Hathaway, which is listed in the United States. They at the moment are sitting on over $380 billion worth of cash in their business. In other words, they're not fully invested into the market. Now, this is at a time when, if we look at stock markets around the world, the United States makes up 56% of global shares in the world. However, those same companies only produce 45% of profits from listed companies around the world. And you can see what this could be alluding to or illustrating is that companies in the United States are perhaps a little too expensive given the amount of profits that they're producing. This is something that we've taken into account in our portfolios over the last 2 or 3 years, where we've been a little cautious on some of those companies in the United States. The world has become very focused on few companies, particularly tech companies in the United States, and their prices have been very expensive. And of late, we've seen some of the CEOs of these same companies suggesting that they think their share prices could be higher than what is warranted. We could see an unwind of this. We've seen some of it already, and I'll show you in the coming slides as how the US has actually performed relative to other stock markets. So having a look at this table, which is in US dollars, shows you how markets have done around the world. And if we start at the month of October, we can see a lot of green there, so markets up quite strongly. You can see particularly the Japanese equity market, after they elected a new president, was really excited about her appointment, and up almost 12% just in the month. But what's probably interesting to have a look at is if you have a look at the 1-year column, you can see developed markets over the last year up 22%, which is phenomenal. Emerging markets up nearly 28%. The poorest performer, which actually was the United States over the last year, was up 21.5% in 1 year. All the other markets, Japan, Europe, the UK, and Chinese equities, all up more than that over the last year. Interesting then, if you have a look over the 3-year column or even the 5-year column, you can see that investors in equities have really been well rewarded over those time frames. If we look ahead, we could see some pullbacks given what I mentioned earlier of the prices of the US equities, but around the world there are still some really good opportunities to invest into equities globally. For our South African investors, this is what the markets have done. If we have a look at South Africa, we can see a nice positive month again, but actually most of the return in the month came from listed property and the bond market, where global investors seem to be realizing how attractive the South African bond market is. And also we had the recent change of being taken off the grey listing, which is positive for sentiment for our bond market. If we look over a bit of a longer period of time, either year to date or over the last 1 year, the all-share index in South Africa up over 32% for the year. And if we have a look even at the 3 and the 5-year numbers, all really strong 5-year return on the JSE of 20.7%. And if you look at inflation over that same 5 years was only at 5%, that meant that you've had a real return, a return above inflation of 15% per year over the last 5 years, which is what our clients would be seeing in their portfolios, some really good growth in their wealth over these last 5 years. So if we have a look at our different strategies that we're running for clients, these are our global models, the ones that are denominated in US dollars. So they think about the world in dollar terms. And interestingly, all of these strategies now have a 9-year track record. So the since inception number covers the last 9 years. And what is very pleasing is to see the outperformance across all time periods and all strategies. What is particularly interesting is how over the last 1 year, 3 and 5 years, the amount of outperformance has been quite pronounced. If we had a look at our balance strategy, where we have a lot of clients in that strategy, over the last 5 years, it's outperformed its peer group by over 3% every year for the last 5 years. And that is probably partly because of our underweight to the US that we've had, but also some good returns from some of the underlying managers doing very well. Here are our global strategies that look at the world through a sterling or British pound lens. The interesting thing here is that these strategies now have a 4-year track record. So they're the youngest of our strategies, but apply the same kind of thinking that we've applied in our global US dollar strategy, but just looking at the world and using managers that invest with a sterling lens. Again, good outperformance, particularly over the last year, and all strategies outperforming over all periods. So looking at our local or South African strategies, here on this page you can see again some really good outperformance in the shorter term. So the strategies generating some very good outperformance of peer groups. But what I would like to highlight on this page, if we take the since inception number now, some of those strategies now have a 13-year track record. So going back, actual money invested for over 13 years. And if we took, say, for example, our retirement growth strategy or our core wealth balance strategy, a lot of people saving for retirement have money in those strategies. Inflation over that period was less than 5%. So you are looking at real returns of a 5% real, which is actually what we would expect from that kind of strategy. If we look over the shorter periods of time, over a 5-year period, for example, inflation there, again, sort of around 5% a year, and you've had returns of 16, 17%. So significant real return growth in the last 5 years in South Africa. What we're going to be doing today is having a look at Japan, the Far East. It's actually a really big economy, but one often, as more Western thinking individuals, we often don't really pay too much attention to. So if we have a look at these two graphs, they are measuring GDP growth. In other words, how quickly is the economy growing? The blue line is Japan, the red line is America or the USA. And we can see from 1960 to 1990, the graph on the left, that Japan was growing much stronger at, in fact, 6.1% per year. Its working population was growing. It was investing into capital projects, infrastructure, that type of thing, and they were becoming more and more productive as a nation. They literally smoked America in terms of economic growth. 6.1 versus around 3.6 for the US. However, in 1990, what happened was their stock market had become too expensive. Their property market was in a huge bubble. In other words, people were saying properties were worth way more than what they actually were worth. And that burst. In other words, people realized, hang on, I'm not going to pay that amount of money for this property somewhere in Japan. And property prices fell through the floor. Their stock market fell off a cliff. You saw people feeling that their balance sheet had shrunk. So they thought their property was worth 100 and actually it was only worth 30. And so therefore they spent less, and that had a knock-on effect onto the economy. America was on the other side of that, in that their economy was growing And we can see the graph on the right, the red line storming ahead. America was growing really strongly, and Japan literally started going sideways for decades. You may have heard the name Shinzo Abe. He was a Japanese prime minister. He was re-elected in 2012, and the phrase was coined Abenomics. He was pushing to try and get the Japanese economy working again. It had had deflation, so prices constantly went down, which meant people would rather not spend as much money, because if I waited a couple of days, that same item would cost less. He wanted to turn that around. So he was actually targeting to push inflation up to 2%, keeping interest rates low, trying to get the government spending again to really sort of flywheel the economy and get it growing again. The two graphs at the bottom here just show, on the left, it shows the Bank of Japan's balance sheet. So it was growing, it was issuing debt, and was trying to get the economy going and even generate the inflation by printing money. On the right, though, it just shows you that actually it didn't work. On the right, it shows wages divided by inflation. So were people's wages carrying on going up? And actually they started gradually going down, which was not the intended outcome. If people's wages were going up, again, they'd spend more, the economy would get going. So fast forward to October 2025. I showed you earlier in dollar terms, the Japanese stock market, the Nikkei, was up strongly for the month. In yen terms, it was actually up 16.7% just in the month of October. And what had caused this? Well, it was the election of Japan's first female prime minister, Sanae Takachi, and she basically came in on promising to put into place what commentators have called Abenomics 2.0. She is wanting to follow in Abe's footsteps, ease monetary policies and bring interest rates down, ensure that the government starts spending and investing again, even seeing the yen come down. She is quite investor friendly, and that's why the stock market has reacted like it has. She wants to cut red tape, boost entrepreneurship, see empowering of women, attract global talent into Japan, and just modernize the whole corporate culture that exists in Japan to see if that can actually get the economy going. And that will be positive for their stock markets as well, hence what we saw in the market now. The one question mark, Japan does not have a good track record of allowing prime ministers to be in power for a long period of time. And on the graph on the right just shows in number of years, different countries, how long presidents or prime ministers, the head of government, usually stay in place. And you can see there, Japan has actually got one of the shortest time frames. Ideally, you'd want her to be there longer so she can implement these strategies more. This huge uptick in October has become known as the Takaichi trade, and it's expected in future to see further weakness in the yen. We expect to see the sentiment towards the Japanese stock market to continue to be positive, and also for value stocks probably to continue and to do well, which is something we've seen in Japan in the past. The graph at the bottom just illustrates the price earnings ratios, so how cheap or expensive are different markets. You can see there that the US equity markets are the most expensive, the sort of greeny colored line. But of late, the Japanese market has become more expensive than probably the average over the last 20 or so years. So that is something just to keep an eye on. Within our portfolios, particularly on the global side, we've got about a 1% overweight to Japan. We've held that position now for 2.5 years. And so this is a positive for our clients' portfolios. Hope that's been of interest to you. We've been through a period of some really strong markets, particularly on the equity side of things, internationally and in South Africa. This has generated some really strong growth in our clients' wealth. At the same time, I hope the Japanese insert just gives you some insight into, we do value diversification where we can find good opportunities and where you can find good shares that are quality businesses at lower prices. You will be rewarded for that in time. And we've seen that with our exposure to Japan. And we have further diversification around the world, which is what we'll continue to do going forward. If you've got any questions or topics you'd like us to focus on in the future, please leave it in the comments below, or just give us a call or pop us an email. We'd love to chat to you.